Welcome back, everybody. Happy summer. Hey, today Paul and I are going to discuss a very common question we both receive, which is, hey, Paul, what happens if I, say 3 years from now, lose my job? What happens to my policy? So what do you say to that?
Yeah. I'm going to give you the life insurance advisor answer. It depends, right? I'll say this, not to give up what we're going to talk about on the podcast, but you have options, right? I think the most important thing to remember, folks, is to reach out to your advisor. If that's us, reach out to us before we get to like the panic mode. Like, hey, Paul, we're seeing this in our industry. I just wanted to, see what my options were going down the road, and we'll go through all of your choices, and probably will make you feel better at the end of the call as well.
Yeah, it's not as bad as you think.
No.
So enjoy. Hey, I'm Dave.
And I'm Paul.
And this is the Wealth Warehouse Podcast. Hey, Paul, looking good, man. Nice headphones.
Yeah, I left my what are they called? Earbuds? AirPods in Tammy's car, and this is my backup. So, look like.
All right, are we going to get the dog on this one this time?
No, I put him in the basement.
Okay,
he's sleeping.
I think the dog's been making an appearance here and there recently. Yeah. All right. We need to knock out some podcasts before kids get out of school. I can't believe. Summer's almost here for the kids. They've got.
When do your kids get out?
Well, it depends. Some of them get out at the end of May, like just a couple days after Memorial Day, and then some of them don't get out till June 10th. So public schools go late here because it's still hardly even feels like summer until halfway through June anyway, and the water's too cold to get on the lake or get in the lake maybe. But I think that's why they do it. But they don't start back up until after Labor Day.
Okay.
Yeah, so they have a full 3 months.
Yeah, not too shabby.
A legit 3 months. But yeah, so while the house is quiet, need to get in some of these recordings so I can do them from home.
Yeah, you are at home. You're not at the vault today.
Yeah. Oh, I'll be there all summer long though, just like last year.
Yep.
Gotta get out of the house to get anything done. But hey, we wanted to give a shout out to some recent clients, right? Some recent listeners. We haven't done this over the last few years, and you had this idea. Maybe we should just do a shout out and thank our clients. We really appreciate our clients. We love working with you.
Yeah. It just happened to. I was actually just walking around here this morning and tidying up, and I was like, we should do that. It just kind of popped into my head. Nothing in particular made me think of it, but it was like, maybe that's a good idea. So Dave thought it was a good idea. So
random thoughts. You just throw a random text message to me. All right, good idea, Paul. That's what happens when you're walking around. You're doing something else, like good ideas just come to you.
Yeah. Yep.
It's funny how that works. But yeah, anyway, we got shout out to Michael and also another Michael. We got two Michaels.
Two.
Yeah. Ben. I feel like most of these people you've been working with.
Yeah, actually, you're right. There's one or two in there for you, I think.
I think I worked with Matt, with Charlie and Riley, and I worked with Wes the first time he came in for a policy, and then you worked with him recently to get one on his grandson. So that's pretty cool.
Yes, that's right. Wes from Texas. And we've got Steven. We've got Tony. We have Adam. And you did Matt, right?
Yep.
You did Wes, and you did Charlie and Riley, and then we have Dave.
Yeah. So we got a good solid group of clients right there lined up. So I think we all those policies are either in force, they're on their journey, or they're just about to be in force. By the time this comes out, I'm sure they'll all be in force.
And James.
Yeah.
We forgot James.
All right. Well, we didn't forget about James. We just didn't write his name down.
Right. And if he's wondering if it's him, yes. Yes, doctor, talking about you.
Yeah. Yeah. So again, thanks for listening, and all these all these people, I don't think any of them came from our personal networks. It was all just listeners. And
Yeah.
maybe they stumbled upon the podcast on their own, or maybe somebody introduced them to the podcast. But yeah, we appreciate it, and that's why we keep doing this to spread the message to more people.
Yeah, and it's something that we like to know. It's something I often ask very early is like, how did you find us?
Right.
And it's just interesting that the path, sometimes there's multiple people in front of, well, this guy told this guy who told me or whatever. So it's
Yeah.
cool.
Yeah, that's always my first question. But speaking of questions, here's a common question that we get a lot, and it's not from everybody, but most people, they want to think worst case scenario and game plan. And maybe it's a military thing, maybe it's a pilot thing. We work with a lot of both. But it's, hey, what if A happens? What's the plan from there? So the common question we get is, hey, what happens if I lose my job 3 years down the road? Say 3 years, 4 years, 5 years, whatever. I get furloughed, I leave the military and don't get another job. What happens then? So what would you say? Do you think that's the right question?
Not really. I do.
It's a valid
I do,
question.
It's a valid question. I like that they're thinking about this because it seems if you ask that question, paying your premium, even though you're earlier in your journey, just starting, seems to be important to you, which it is. It is important. That's why we're doing this. You can't become your own banker without paying your premium, right? So I think not a terrible question, but the first thing I'm going to be wondering probably, Dave, is, gosh, I've got a mortgage, I've got car payments, I've got kids' tuition, I've got utilities, I've got student loans, I've whatever, groceries, life, right? I've got life expenses that's probably going to be first on my mind, I think.
Yeah, I mean, that's really what people are asking is, I've got all these other bills. How am I going to pay my premium and keep this thing going? Usually my first response to that is, well, I think if that happens 3 or 4 or 5 years down the road, you're probably going to be pretty happy that you started this 3, 4, 5 years ago. And you have a significant pool of capital from which you can pull to pay your mortgage, pay for groceries, pay for gas, pay for children's tuition, everything else. Right?
Yeah.
So what happens if you don't do this? That's a question I would throw back. If you don't start storing your capital here, where are you going to pull from? What money are you going to pull? Where's it going to be?
Credit card. It's going to be from credit cards.
Yeah.
At
And we'll
20%.
talk about other places you could get money and how really none of them are going to have the advantages of the capital that you have inside of your dividend paying whole life insurance policy.
Yeah. And if you go back to some of our earlier podcasts, Dave, you had a deliberate plan as you left the military and then corporate America after that, where you wanted to have a certain level of cash value available to you,
Right.
so that you could go take the next step to becoming an entrepreneur. And that enabled you to make that decision and to take that leap into full-time entrepreneur as well. So I think you nailed it when you said you're going to be thankful that you started this thing 3, 4, 5, 6, 10 years ago, whenever this catastrophic event actually occurs. The later it occurs, of course, the more flexibility you will ultimately have, not only to pay the premium, but also just to live and to kind of reset and figure out what the next step is.
Absolutely. So let's talk. This is really the answer people are looking for is how do I pay my premiums? They want to know, if I no longer have an active income, how do I pay my premiums? And I always caveat that with, okay, we're thinking worst case scenario. You lose your job and you don't get another job. You have zero income coming in, which may be the case for a little bit, but let's be real. I mean, we could talk hypothetical all day long, but the fact is you're going to get another job. Whether you could just get in your car and start driving for Uber or, dropping off food, Uber Eats or something like that. Like, you can get a job tomorrow if you want to. by doing
Yes.
some of these things. So you're not going to be unemployed for as long as maybe that, that fear, that thought in the back of your mind tells you you are. But anyway, regardless, how am I going to pay my premiums, Paul? I lose my job 3 years from now, premiums come and due. What do I do?
Sure. Well, you've established cash value, right, in the policy. So some of that could be used to temporarily fund the premium.
Yeah, absolutely.
Using policy loans to fund the premium. In other words,
that money can be used for anything you want. You're the banker.
Yes.
And I've done that. I've done that exact thing probably for 2 years in a row where I took a loan out to fund my premium. I'm working with a client who about 6 months ago said, "Hey, my premium is due." He was under the impression he had to pay the full premium, the full annual premium like next week. And he's like, "I don't have the money for that." So he called me, which good on him. He let me know before, it was way too late.
right.
And so I
Some
could
of
help
you
him.
don't do that.
Yeah, please let us know before it's too late. Like, get on the front end of this. Don't be embarrassed. It's not like we haven't seen this before, or I haven't done it myself.
Right.
So what we did, we just called up the insurance company. I know how much cash value he had available, and I instructed them, "Hey, I want you to take a loan against his cash value and make a quarterly base premium payment. That's it." Now, they're typically not going to let you take the loan to fund PUA because it doesn't really make sense. But to fund the base, they will absolutely do that. It was over the phone. It was a phone call. It took, less than 5 minutes. And they, took a loan, applied
the
it
loan to
towards his
premium.
next quarterly premium. Now he's got 3 months of runway. And he still has enough cash value to make a second quarterly premium. And then I tell him, "Hey, in the meantime, anytime you have extra cash, you need to be throwing it back against that loan repayment so it's available for you to do that again next quarter if you're still in the same situation."
Yep. Yeah, solid. Yeah.
Yeah.
What people don't realize, we interact with our policies or other people's policies every single day, right? And we don't expect you guys, that's why we're here. That's why we're your advisor when it comes to this stuff, is that there are options that you're not likely going to think of. Some of you will. Some of you more advanced clients will. But if you're not at that level, that's okay. That's why we're here. We're here to advise you on what is the best course of action to get to the outcome that we want you to get to.
Right. Yeah. Okay. Now, here's one that a lot of people don't even realize unless they've read through the whole contract and they remember this part where there's a grace period. Every life insurance company allows you at least a 30-day grace period.
Yep.
So you do not have to pay your premium on the payment, on the anniversary date. So some people freak out. They send me an email. And they're like, "Premium's coming due tomorrow. I think it's actually I'm not going to be able to pay it until next week. I didn't get the money transferred from one account to another in time to make." I'm like, "Relax. It's okay.
Yeah.
You have 30
it's
days.
Totally fine. Yep.
It's not a big deal." Yeah. So you got the grace period.
Yep.
Now let's speak to the flexibility of this.
Sure.
So what would you recommend if they can't make the full premium payment? What's the next step there?
Well, you could just pay your base premium and then whatever fee you have to keep your PUA rider available for future PUA. So typically, that's a small fee, $120 a year. So you could pay your base premium plus that fee and fund the premium that way.
Yeah, because you definitely want to keep that rider on there so that, hey, you get a job in 6 months and you can start paying that PUA again, or you get, next year, a year goes by and you didn't make any PUA payment, but a year from now you're back on top and you can make that PUA payment. You want that rider on there. And like Paul said, yeah, it's something like $10 a month, typically.
Yep.
To keep that on there. Not a big deal.
Not a big deal.
Yeah. So that speaks to the flexibility, the way we design these policies, where you have a lot of flexibility in general. I mean, every policy is different, but oftentimes your minimum required premium is about half of what your total premium is. So if that total premium scares you at that point, just realize, hey, I actually only need to pay half of this. And
Right.
I could pay it on a monthly basis. I could even take half of that premium, split it, divide it by 12, and that's what I need to pay today.
Yeah, you could change the mode of premium.
Yeah.
Right? There's typically 4 modes, right, Dave? There's annual, which is the best way, semi-annual, like twice per year, quarterly, which is 4 times per year, obviously, and then monthly, right? 12 times per year. So, yeah, you could switch mode of premium, which people have done. They've bounced back and forth. We've had people go from monthly to annual, annual to monthly, annual to quarterly, whatever.
Right.
Right? You have options.
Yep, you definitely have options. So, now here's one. We have a whole episode on the dividend. But one of the options on the dividend, and it's not that we recommend it, we certainly don't want to design the policy for the dividends to be used to pay the premium, but that is one of the options. If you get into a pinch, you could tell the company, hey, no, I've got a dividend coming at the end of this policy year. Please apply that dividend to my policy premium. And it just offsets the amount you have to come in out of pocket with.
Out of pocket, right.
Yeah.
Yeah, and we've also talked about before how, as time goes on, the policy gets better every single year, and the deeper you are into the policy's life, the more appealing some of these options are actually, right? So in a huge pinch, like 12 years in, let's say, to a policy, you can use the dividend to pay the entire base premium.
Yeah.
Indefinitely, if you wanted to. Again, don't advise that. Recommend funding a policy with new money every single year. But this could be done, right? And a lot of people find that really appealing, especially when the question becomes, well, Paul, when I retire and I'm 70 and I'm not laboring anymore, I can pay this premium without question right now because I'm in my prime. I'm in my 40s, 50s, whatever. I'm crushing it. But what happens when I'm 75 and I'm no longer doing any of these things? And I was like, well, here are your options. We kind of roll through the non-forfeiture options.
Yeah.
And premium offset being the one that I would pick first.
Sure.
Over reduced paid out.
And by that point, you're probably, if you've had that policy for a couple decades, by that point, you're going to be at the point where, hey, use my dividend to offset my premium, and then whatever's left over, send it to me in a check. You could do that. Right? Yeah. Or whatever's left over, buy more paid up additions, because there's going to be more dividend remaining than what had to be used to fund your premium at that point.
Yeah. And your agent can show you, if we're not your advisor, can show you kind of what the difference would be long term of doing something like that and what the policy will look like as the years go by. Yeah. You might find the money to fund the full premium, especially on a mature policy that's just awesome at this point.
Yeah. It's just multiplying in cash value every time you pay a premium. Yeah.
Yep.
All right. So you mentioned non-forfeiture. There are some non-forfeiture options where we talked about this one before, reduced paid up, RPU. Is probably the most common non-forfeiture option. What that means is you're not going to forfeit the policy. The policy does not lapse. They just consider the policy paid up at that point and determine how much death benefit you have, what your cash value is, and it does not allow you to fund any more premium. It's cut off. It's like it's a paid up policy, fully paid up.
It's paid up. That's right.
Yeah.
Yep. And it'll be reduced. That's really what it means, right? So if your policy is a lot of you have pay to 75 or pay to 95 or pay to 85, pay to 100, pay to 121 policies, right? Those are designed to be paid up at those ages, right? So if you're not paying that premium for that duration, of course, the face amount of the policy, right, is going to shrink by whatever amount, depending on when you do it. So just note that, as long as you understand the consequences of that, it will still grow though over time. It'll still receive dividends and it'll still grow, but generally all the riders are gone off of it.
And that is one of those, last resort kind of options. I have no more money to pay this thing. I want to keep the death benefit in force, so let's just RPU it.
Right.
It's possible.
Yep.
Yeah. But here's what happens if anybody cares. If you do decide you don't pay your premium. You don't have any cash value to borrow against in order to pay your premium. You got no way to keep that thing in force. You just let it ride and it'll eventually lapse on its own. What happens is at a certain point, it just becomes what they call extended term insurance. So the premium you paid up to that point is going to be used to fund extended term insurance until they calculate that terminates based on how much you paid.
Right.
Yeah. And then at that point, then the policy is surrendered. It's lapsed. You no longer have it.
That's right. That's not an ideal scenario, although not terrible at the same time. It's recoverable if you can begin pay catch up premium. You can actually get that policy reinstated as a whole life policy.
Sure. Yep. So hopefully you never get to that point. If you do, we should have talked well before that happened.
Right. For sure.
Yeah. There's another thing called partial surrenders, which again, it's one of those things. Maybe there's a strategy for it later on in life, but instead of taking a loan from the insurance company, you just surrender part of your policy and take that cash value out permanently. It's like removing the equity permanently.
Right.
From your policy.
I don't like that.
Me neither.
In other words, you're interrupting compounding.
Yeah. And you're basically
that's what you're doing.
And you're assuming you're never going to be able to pay that back anyway.
Right.
So
it's permanent.
Yeah. You don't know what tomorrow brings. Maybe you will be able to pay it back and you're going to wish you had just taken a loan instead of surrendered it.
Yeah. The way I look at it, Dave, is I want the maximum amount of options.
Yeah.
The maximum amount of flexibility. And if that means policy loan, so be it.
Right. Yep. Okay. So Paul, we paid the premium, or maybe we minimized the premium in order to get through this rough patch that we're in until I find another job and get back on top. How does this affect my policy and my ability to do infinite banking?
Sure. Well, certainly you've slowed the growth of the policy, right? Because the policy was designed to accept a certain premium level, right? So your premium is $25,000 a year, and you've been paying $12,500 for a period of time, which is the base, let's say. Obviously, the policy is going to look a little bit different. However, right, there is opportunity with some companies to pay catch-up PUA in the following policy years. So, but yes, no question, it's going to look different because you have interrupted the premium that was, designed to be accepted into that policy, right? You've interrupted that, or reduced that, I should say, and you've affected the policy permanently. Yeah. Is it a huge deal, though? No, because really, when you look at how much death benefit PUA is buying, it's not that much.
It's not that much.
So it's really not that big a deal. So I always tell people, I was like, listen, you're majoring in the minors. You're focusing. It is true. Yes, it's going to be a little bit different, but a little bit different. Really not that much. Let's not split hairs over almost nothing.
Yeah, you're going to slow the growth. You're not going to eliminate. It's still going to grow. It's just going to grow slower because you're funneling less capital in it, which totally makes sense. If I'm going to put less money towards it, there's going to be less growth.
Which is why a policy with a properly designed and significant base premium aspect to it is better. Yeah. Because if your policy is all PUA and you're not paying that PUA,
yeah, it's going to look nothing like you intended it.
Nothing.
To look. Yeah.
It's going to look terrible.
Yeah. Now, another way this is going to affect your policy is if you're taking loans against it to pay your premium, then of course those loans are going to accrue interest. Mm-hmm. And that interest is just going to continue to accrue on a daily basis until you repay the loan. And then you can repay the interest. Right. Or make an interest payment at the end of the policy year. But yeah, that's another thing is that interest continues to build. And then if you were to surrender this late in life, like you've had this thing for a couple decades, and for some reason you end up surrendering it, taking out all the cash value, there could be a taxable scenario, a taxable situation if that cash value you're taking out or all the cash value, the loans you've ever taken against your policy is more than what you ever paid in premium, which at some point it will be, right?
Sure.
Almost assuredly, it's going to get to the point where you're going to have more available than you ever paid in. And
Yes.
that delta will continue to grow and get bigger and bigger every year until you die.
Yep.
But if you took that cash out, the man wants his money. Give the man his money. He's going to.
Yeah, because it's looked at as you weren't using this as an insurance product. You were using this as really like a traditional qualified plan product. It
Right.
just happened to be life insurance, right?
At which point, any gains, anything above what you ever put in, that's going to be ordinary income to you,
Right.
in the year you took it out. So
Right.
something to keep in mind later on. That's not a factor in the first few years. If you needed to surrender your policy early, not a factor. Later on in life, definitely a factor.
It should never be a factor, folks.
No, not when planned correctly. Now life happens, but that's why you build up significant cash value right now when you can.
That's right.
To get through those bumps in the road. And nothing lasts forever.
Plan like the future's unknown.
Because it's almost like it is.
Almost like it is. Yeah.
Yeah. And I look at when I talk to people and they're like, I'm having a tough time. I don't know if I'll be able to fully fund my premium this year. My question is what are you funding right now that's not going to make a lasting impact on your life? Maybe you need to cut back elsewhere, whether that's, you get a cheaper car, lower car payment. Maybe
Stop paying your children's cell phone bills.
Yeah,
Your
stop
adult.
paying.
I mean, your adult children. Like, why are you paying? We're on the plan. Well, make them pay that part of the plan.
Or stop paying their college tuition. Like,
Yes, this is a
care of-
conversation I've had with people.
Take care of your house. And this is your policy. And who's going to be the beneficiary of that? Well, it's going to be your spouse and maybe eventually it's going to be your children. Anyways, so doing this is actually taking care of your children.
That's right.
Yeah.
Yeah, it's a great point. It's it's super fun. There's things that can be cut. Not that I'm in favor of doing that. We want to live well. We want people to enjoy. You want to enjoy life, but certainly this should not be in the way.
No, we never designed this to be in the way. It's really designed to be just a part of your current cash flow situation.
That's right. You take existing money you have, we just put it in a different place first.
Yeah,
Right.
that's it.
That's all we're really doing. So
Yeah. Also look at where else do you have money residing? Your money has to reside somewhere. Certainly this isn't the only place you have money is inside your policy,
right.
right?
So there's a lot of red money out there, Dave. Red, RED, like the color. And that's how on our when I'm doing our financial review with our clients, I color that red. Home value, home equity, red. Qualified plan, red.
And why is it
IRA.
red? What does red mean?
Red means it's not available to them to spend, to turn into spendable dollars.
Right.
And I've never seen in the in 3.5 years we've been doing this podcast, and the 5 or 6 years now in the business, so much regret of not knowing about this concept that long ago. So they could have put more money in a location where they could get at it. It's really interesting. And it's every single person now. They're just like, oh, I got all this. I've got $434,000 in TSP. It's like,
Right.
yeah. And you have a pension. Like, why did you put money in there? He's like, I don't know. Why did you put it in there? I don't know. They told me to. And it's not that I have regret, right? I'm glad I established discipline, right?
Right. And consistent.
And consistent discipline over years and years and years. And that's great. But man, I'd love to have that money. It'd be so much better.
Yeah. And all you did when you discovered the infinite banking concept is you translated that discipline. You kept it going. You just did it in a different place. And now,
I use the same exact dollars.
now you got more access to capital in your private contract and the equity of your death benefit than you have anywhere else.
Yeah. Much more peaceful way to live,
Yeah.
for sure.
Very
And it
nice.
makes a lot more sense if you just think about it for 3 seconds. Just makes a lot more sense.
Yeah. Yeah. And hopefully you don't have to, do what banks do when there's a bank run is sell at a loss. All the money they have in these long-term bonds, they got to sell and take a loss on them, take a haircut.
Yeah, they do.
But that's that's something you could do. You could always withdraw money from a qualified account. You're just going to take a haircut.
Yeah.
But it's there.
Yeah. Yep.
And what would you rather do? Let your family starve, get your house foreclosed on, or, take out of a qualified account? For some reason, that seems to be the last resort. Like, I'm going to do anything and everything in my power not to pull any money out of my 401k. Because they're taught, like, you should never, ever, ever touch that money.
Oh, it's absolute blasphemy to even think about it.
Yeah, just suffer now because that's going to pay off down the road. Well, if your family can't eat right now, there's a little more important things than my retirement plan.
Folks, if you ask that question to like ChatGPT or one of these other AI, whatever, hey, I'm thinking about withdrawing out of my 401k early, that is going to be a focal point of what it tells you. However, experts say that you shouldn't do this because, whatever, taxes, penalties, interrupting compounding, all these things, right? Which is just not incorrect, but
yeah. Well, I would just follow that up with ChatGPT or Grok AI and be like, well, but I don't have money for groceries and my family is starving. Should I use my credit card and run up credit card debt? Like, that's another one where people will be like, I'll just use a credit card and pay 29% interest instead of taking out of my 401k that's earning me an average of 9%. Like, that doesn't, do the math.
right.
It doesn't make sense.
And a loan from like your 401k, if that's available to you, you can put that money back. It is a loan. Right. You have interrupted the growth of that portion of the money. However, you can put it back, and you're going to have to put it back. Actually, it's a loan. You have to put it back.
Yeah.
But the terms are a lot better than credit card. A TSP loan right now might be at like 4.5%, 5%.
You can't get loans much better than that anywhere else.
No, not a personal loan. That's for sure.
Right. Yeah. All right. So there you go. Now, just some endings to summarize some of these considerations. From the beginning, the way your policy is designed matters, which is why who you're working with and what company they're working with, all of that stuff matters because you want this inherent flexibility built into your policy from the get-go. And you want to work with somebody who knows all the options in case you ever get in a bind like this. So what's the first thing somebody should do if they see this on the horizon? They get the furlough announcement from the airline, or they got, they see the massive layoffs coming to their industry because of AI or whatever. What would you say they should do first?
Call your agent.
Okay. So if you're our client, I hope you heard that. Call your agent. Call me. Call Paul. Get a hold of us so we can
better
plan.
call Paul.
Better call Paul. Yeah. Good one. There you go. Bad news doesn't get better with time.
Yeah, and maybe we can give you some good news, right, Dave?
Like maybe we can take the pressure off and tell you, hey, it's really not as bad as you think it is. Let's take a look at this.
Right.
You have options.
Give me all the facts, and then you can make an informed decision from, with factual information rather than a situation from panic.
Yeah. Yeah. Hopefully you can get a hold of your agent. I know a bunch of people who, got policies at the big, well-known companies, and they try to get a hold of their agent. Well, no, your agent's no longer in the business because he was 21 years old and he decided to, selling life insurance wasn't his thing. So we're going to go pass you on to a brand new 20-year-old who has no financial incentive to help you and doesn't have any experience.
It's there's a lot of churn over there. It seems like, we are career professional agents, I would say now, right? Like this is our careers, right? Our second careers, right?
Yeah.
Or in your case,
Third,
fourth career,
whatever. Yeah. It's a career,
right? Yeah. It's a career. It's what we do.
Profession.
It's a profession. I'm not looking to step into anything else. Like you and I could go be real estate syndicators. No question. Don't want to.
No
We
desire.
could go fix and flip homes. Don't want to.
Nope.
I want to do this. Right. So anyway, call your agent. If you can't get a hold of them. This is fairly common, but we get clients from other agents. Either they're not in the business anymore. I've had agents that have passed away.
Yeah.
So, it's one of those things. So you want to expand your system? Give us a call.
Yeah. And realize, just a parting shot here, every year, this hypothetical emergency actually gets easier and easier to handle.
That's right.
So you made it 3 years, great. Then if something happens in year 4, it's not going to be that bad because you've accumulated capital. As long as you've been paying significant premium relative to your income, right? As long as you've been doing that, you're going to be okay. You're going to weather the storm just fine.
Yep. And the people paying significant premium have all read Nelson's book, and they get it. If you are not paying significant premium relative to your income, that means you do not get it yet, which is okay. Keep learning, keep studying. The epiphany will come.
Keep listening. Yeah. Hopefully we got through to somebody. And if you're experiencing any of those issues right now, again, reach out to your agent. If you're a client of ours, definitely reach out to us. We want to help. All right. Well, good. Hopefully that's an episode nobody actually has to put into practice, but undoubtedly some will. So we want to throw it out there.
Yeah, this was pretty educational, I think.
I
think, read your contracts, too. It's all in there.
Yeah. Yeah. And it's heavily beneficial towards you, the policy owner. Mm-hmm. It really is.
It is.
Yeah.
Yep.
With the right company and the right policy.
The right advisors.
All right, everybody. Enjoy. Have a great week. And enjoy the beginning of the summer here. And until next time, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.